All right, everybody. Welcome to NCPERS webinar. Today, we'll be exploring the annual Public Retirement System Study and Dashboard. My name is Hank Kim, and I'm NCPERS Executive Director and will act as host for today's webinar. Today's program is part of our Center for Online Learning, which provides remote continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. In today's webinar, we'll review the findings of the 2025 Public Retirement System Study, or PRS study, that we released just recently, and highlight the key trends and takeaways from this most recent edition. NCPERS has been conducting this annual survey since 2011, and we think our study is unique and insightful because it, it's produced from survey responses from the full vertical and horizontal profile of public plans. What do we mean by that? Well, you'll have to stay tuned. We'll explain that shortly. I'm also excited to announce that we have a new research partner this year, Greenwald Research. Greenwald leverages industry expertise to produce trusted insights that drive understanding and inform strategic action. This new partnership brings more than just a refreshed look to the PRS study. We'll get into the details momentarily, but I think you'll agree that the data is richer and more useful than previous iterations. Now, I referenced the PRS study a couple of times, and ideally, you should have received an email from us directly with instructions on how to view and download the study. In case you haven't, loading into the chat right now is a link to our website where you can do just that. You will get to a landing page that shows our two annual surveys, the PRS study, as well as our annual public pension compensation survey. Each of our annual surveys comes with the dashboard. The dashboard is an online interactive platform that allows you to use filters so that you can have a better apples to apples comparison. And as part of today's webinar, once we're done with the formal presentation, William Whitman, our Membership and Strategic Alliances Director, will demonstrate the PRS dashboard. One last administrative notice before we get started. We welcome questions from the audience. We want this to be an interactive session, so please use the Q&A function on Zoom to pose any questions you have to the panelists. However, to ensure that we can get through their presentations, we'll answer your questions during the last portion of the webinar. All right? Okay, let's introduce our two panelists. First is Eric Sondergeld. Eric is a seasoned researcher and strategic thought leader with experience in insurance, retirement, and investments. Eric was most recently corporate vice president and director at LIMRA, leading the technology research and developmental and strategic research teams. In this role, he ensured that LIMRA produced relevant research to help member companies effectively utilize technology, examine strategic issues that may impact the industry, and monitor trends in the global financial services marketplace. His colleague is Doug Kincaid. Doug has more than 15 years of financial services and market research experience. Doug's work focuses on retirement savings and retirement income studies for many of the nation's leading financial services companies and trade associations. He manages two of Greenwald's syndicated studies, the Retiree Insight Program and Guaranteed Life Income Study, and is sought out for his insight on plan sponsor and participant views on retirement plans and income solutions. Doug, Eric, welcome, and thanks for joining us.
Thank you, Hank.
Yeah, thanks, Hank. Very much appreciate the invitation to join today, and also want to thank everybody else who's joining today and your interest in this research and the data. Before we get started, I did want to say two things. One, Greenwald is celebrating our 40th anniversary this year. For most of those years, we've been probably most known for tracking retirement confidence among workers, among retirees, and trying to better understand kind of how people think about retirement. The past few years, kind of looking at confidence, have really been one of a story of resilience in terms of kind of recovering from tough financial periods, and from the worker perspective, how they're adjusting and how they're thinking about retirement. This work with NCPERS has been a really interesting opportunity to see the story from the side of pension systems, which I think, as Hank will probably speak to at some point on the session today, is also one of resilience in recent years. But it's been an interesting opportunity to see kind of the other side of that. The second thing that I wanted to mention, and there may be people who participated in the survey who are joining us today, so I'm not just trying to butter up people who are joining to hear this research, but respondents of the survey deserve a huge shout out for undertaking what's not an easy survey. So this is not just a attitudinal survey where all answers are correct. There's detailed questions about plan assumptions and investments, as well as kind of forward-looking questions about priorities and how they're thinking about the future, which sometimes is a harder question than just asking about kind of current investments. But we had a record turnout in terms of respondents to the survey. We had, in some cases, teams of people representing certain systems who were helping to fill out the answers to this so that they could get their response submitted. We had lots of back and forth with individual respondents trying to make sure that they were interpreting things correctly and wanting to ensure that they got their responses in on time. It's a type of engagement that you don't really see in this type of data collection. And I think it's a testament to NCPERS, but also especially everyone who participated in this. So didn't want to kind of launch into the results without giving full credit to the hardest work involved in this, which is kind of putting this all together and sending data in. So I wanted to mention that on the outset first.
And Doug, if I could interject, I think that level of engagement and buy-in is also leading to one of the highest turnouts of NCPERS webinar history. So again, thank you for all the plans and the staff who participated in the PRS study, and thank you for the over 160 folks who've tuned in and nearly 300 who've signed up.
So I'll turn it over to Eric, who I think is going to introduce some of the methodology here.
Excellent. Thank you, Doug. So this study was conducted last fall. It was the 14th iteration of the study. As Doug mentioned, we had record participation. Over 200 plans or systems submitted data for this study, representing over $3 trillion in pension plan assets. There are really two sources of information that we asked people to complete. One was some information about the finances, essentially, and mechanics of their plan, which we asked them to gather from their most recent annual comprehensive financial report, or ACFR. And then there were a variety of questions that were more general about the plan and their practices and kind of where they see things going in the future. We'll be covering all of that today. What I want to show you on the right-hand side is something that we added in this year in the analysis. This is one of the things that Hank was hinting at a few minutes ago, is for the first time, this study is able to split the results out by fiscal year period rather than just by the year in which the survey was conducted. So for this particular report and today's presentation, we've leveraged data from the most recent 4 surveys. And because the availability of and timing of ACFR reports varies by when the fiscal year end period happens and when they fill out the survey, we get a variety of different fiscal year periods reported. So for example, in the 2024 survey last fall, most all of the plans reported were reporting um, on fiscal year end periods in the first half, second half of 2023, or the first half of 2024. But when we combine all of the most 4 recent years of the study, we end up with quite a wide range. We have, in fact, 4.5 years of fiscal year end periods. There were a few more before that, but the numbers aren't big enough to report on and using those 4 years. But what you'll see in a lot of the slides today is charts that look like this one on the right, where the legend says something like 2020.1, 2020.2. Let me just quickly describe that. So what 2020.1 represents are any plans whose fiscal year end period falls in the first half of that year. And a 0.2 is any plan or system whose fiscal year end period fiscal year end date falls in the second half of the year. We made 2 very small exceptions to this rule. And it was a rare case, if they had a fiscal year end of January 1 or of July 1, and there were a handful, we considered them part of the prior period, because the vast majority of plans have a fiscal year end period at the end of the half of the year, so June 30th or December 31. And this way, when we're looking at investment returns and funded ratios and things like that, we can get a much better apples to apples comparison looking at the results by fiscal year end period. Hopefully that was clear and not confusing. So I'm going to hand it back over to Doug to discuss a little bit about kind of who responded.
Yeah, so I just wanted to mention some of the big picture demographics here of who is in this data. And as Hank mentioned, it does represent kind of the full vertical and horizontal. And here we have a vertical and horizontal chart to demonstrate that. We have a wide range of plan assets. So you can see going from smaller plans all the way up to, we have kind of over a quarter of the respondents for this year have 10 billion or more, and a good portion of that in the 50 billion plus. So there's a good spread of who these plans represent. It's also the case that we have respondents who represent systems that touch in public safety, local, county, educational, state, and other. As you can see by the percentages there, it's not a single type of employer beneficiary that usually a system represents. So there's overlap, quite a great deal of overlap there, but the overall kind of spread of different types of systems, I think, benefits this research so that it kind of gives you a wider range of who these people represent. I think also 3/4 of responding systems cover general employees, so those are the local, county, and state.
Yeah, I will just add that this, I think, in very much is representative of NCPERS membership. NCPERS as the largest, we representing roughly about 500 plans and plan sponsors and other stakeholders. We have some of the largest statewide plans, as well as some of the smallest, local municipal plans. And while this survey instrument was sent out to, I believe, Doug, correct me, the largest 600 plans, as captured from the U.S. Census Bureau, some of them not being NCPERS members. I think what we've captured is very representative of the membership.
Yep. Okay, Eric, if you want to move on. The other thing I think is interesting up front and gets to the point of what Hank was saying, that there's a diversity of types of systems represented here, including the very small, is this question that we ask about the number of staff administering the fund. And you can see the largest percentage have under 10 staff working on the fund. I think the median number across everybody was 15, which you can see based on kind of how the distribution is there. But there's a wide range. So we have systems with the plans that are serving 20,000 or more members. They have a median of 116 administrative staff, whereas ones that represent plans with fewer than 2,000 members only have, a median of 2 or in the single digits of staff working on it. I know this is something, Hank, that you were interested in, especially calling out. Was this obviously the trend of larger systems, larger plans, having more staff behind it makes sense, is not surprising. Is this distribution surprising to you at all, though?
Not really. And I think as we go through this presentation, we'll tease some of this out, particularly with some of the other slides relative to, administrative costs of public plans. But I think generally what you see here is that public plans, are very efficient. They are very, they husband their resources, and the staffing is representative of the needs of the plan. So yeah, I think these this tracking is one of the things we'll be looking at going forward. And again, as a teaser for William's session, again, I think this is where the dynamic dashboard can really help, where you can sort of add or remove filters to see, again, apples to apples, your peer plans, how you compare staff-wise and other metrics that we've captured.
Sure. One thing I wanted to mention before we get into the kind of real results, and we've only kind of teased at some of the key findings in this webinar. There's a rich report that's now available that has lots of detail about a variety of different topics that were in the survey. But before we get to that, wanted to mention that I think, explaining these demographics up front is useful for understanding the context of the results that we're seeing. But I think it's also a really interesting opportunity for NCPERS and for everyone who's interested in this. As Hank said, the dashboard is a good avenue for being able to explore this and to look for kind of relevant comparisons that would be interesting to you. But there's also, I think, an opportunity going forward to kind of try to understand more about who these systems are and what are the characteristics that make up how they administer the fund, what they look like, who their members are, to try and understand patterns in the data that we're seeing and how they kind of respond to priorities going forward. What are these different types of systems think about the future, and how are they kind of approaching challenges that they're facing? So demographics are always kind of a core part of survey research, but I think in this case, there's a real kind of rich possibility there for kind of digging in more and better understanding what these results represent. So I'm going to flip it back over to Eric, who kind of led a lot of the analysis in this work. He's going to talk a lot about kind of the actuarial and economic assumptions data, the investment data. I will jump back in at the end to talk about some of the operational and kind of forward-looking priorities and other types of questions results.
Okay, thank you, Doug. And I'm glad you mentioned that there's an opportunity to dig deeper. So there is a pattern that you will see in a lot of the charts by fiscal year end period, where the lines kind of waver up and down a little bit. And there seems to be a distinct difference in some way between plans with fiscal years ends in the first half of the year versus second. And we have some information that helps us understand part of that, but there's still more to explore to kind of understand what's going on behind the scenes there. So let's jump into some of the actuarial assumptions. We have 5 different assumptions we're going to talk about here. The first one being the discount rate, which is a critical assumption in valuing the plan liabilities. which is then used for determining things like funded ratio, where you don't have to come up with any assumptions to value the assets today. Those assets have values that you can measure, but measuring the value of the liabilities takes some assumptions. One of them is the discount rate. So in this case, what we're seeing is that the discount rates are slowly creeping down. They declined from an average of 7.13 in the first half of 2020 to 6.67 in the first half of last year, which indicates that responding plans assumptions are getting slightly more conservative. Combining this with an observed increase in plans receiving the full actuarially determined contributions in 2024, which we'll get into a bit later. These 2 points suggest a trend toward plans being able to better withstand economic shocks. On this slide, we have 2 more assumptions to share, starting with inflation on the left. The respondents' assumption for inflation have stayed relatively consistent, with the median at exactly 2.5%, while some systems assume an inflation rate below 2% or above 3%. 8 and 10 use 2.25, 2.5, 2.75, or 3%. And these 4 inflation figures have been used by 12%, 39, 17, 11% of systems, respectively. Now, on the right-hand side, most systems incorporate an investment smoothing period to recognize investment gains or losses over multiple years, which helps reduce volatility in funded ratios. 3 and 4 systems that do so use a 5-year smoothing period, with relatively equal numbers smoothing over shorter or longer periods. This chart is a bit busy, but it's very colorful. So amortization periods vary considerably. So the median has remained level at about 20 years, and the average has dipped slightly in the most recent period to about 18.5 years. And this is the number of years in which a plan will amortize the remaining liability over as they seek to get to full funding. And on this next slide, this shows that really the 2 main types of ways that plans can use amortization. One is open or rolling, and the other is closed or fixed. The difference is that with closed amortization, that type is designed to reach full funding by the end of the amortization period, where open or rolling amortization will continue heading you in that direction, but isn't designed to necessarily get you fully funded by that period. My understanding is there's been a fairly long trend towards using closed or fixed amortization. I think much of that trend probably happened before this study, but there's a very significant percent that use an increase in closed or fixed amortization, if I said open. One thing I would just take caution with is the 2024 first half number, which shows a dip in closed or fixed amortization. I don't believe that's indicative of a trend. I think it just happens to be the fact that we don't have as many systems reporting for that time frame yet. And I believe with next year's survey, we'll be adding quite a few more plans that report on the first half of 2024 as the most recent fiscal year-end period they can report on. And I believe those numbers will look a lot more like the ones that preceded on this chart.
Eric, could I just add a little color here?
Sure.
You know, over the last 14 years, this type of amortization is where someone who's been with the with those surveys of the past 14 years sees a significant flip. So when we first started the survey back in 2011, I believe roughly 2/3 of plans that reported they reported open or rolling amortization, and only a third reported closed or fixed amortization. And as you can see, over the subsequent 13 years, it has substantially flipped to the more best practice of closed or fixed amortization.
All right. Let's continue. So in the survey, we asked for very detailed asset allocation information, and some of that's in the report. Here, we're just summarizing it by the main categories: equities, fixed income, alternatives, and cash equivalents. So equities will remain the largest component of pension portfolios. However, we saw a sharp increase in fixed income investments, reaching 26.1% in the most recent fiscal year period. This is one place where I do believe that 2024 first half results are indicative of a change. There's some corroborating data that was just published earlier this month by Pensions and Investments that shows that among both corporate and public pension plans portfolios, there was a significant increase in fixed income allocations last year. We also ask for the 1, 5, 10, and 20-year returns that these systems have experienced. Average 1-year returns, net of fees, have reached 9.47% among systems with fiscal year end periods in the first half of 2024. It's interesting to see how quickly these lines converge. As quickly as 5 years, the lines are very, very close and very flat. And very close to the 10-year and 20-year. I think this is further evidence supporting selection of even a 5-year investment smoothing period, where you're going to get fairly consistent returns over time when you select a smoothing period like that. Reinforced systems report cost of living adjustments in their most recent fiscal year period, typically using either a fixed rate or a CPI-based increase with a cap. However, there are many systems that use a combination of these or have different tiers of COLAs for different types or classes of employees or beneficiaries, or they might use a factor of the CPI or some other means to calculate COLAs. And those are all represented in that right bar on the 25%. And on this next slide, the average COLA paid in the most recent fiscal year was 2.81%. However, the median and the most common COLA paid by over half of systems was exactly 3%. COLAs otherwise range from paying nothing in the most recent fiscal year to as high as 7%. So there are two primary sources of expense for pension plans. One is the fees paid for investment management, and the second are costs to administer the plan. And over the past several years, these costs have been relatively stable. Or level. They fluctuate a little bit. If maybe they've increased slightly over that time period. And the administrative expenses, which plans are able to manage much more efficiently than how much they have to pay for investment management. The categories that go into that primarily are things like staff salaries, staff benefits, consulting fees, member communications. The vast majority of plans have each of these types of expenses, and the very largest plans pretty much have all of these categories of expense as part of their expenses for managing their plans.
Eric, if I could just jump in again, and again, I think here is what I was alluding to at the beginning when we were talking about staff sizes and the number of staff per the size of the plan. Again, I think the fact that in the average admin expenses is around roughly 20 basis points, I think speaks volumes to, again, the efficiency of public systems.
Good point. All right, so all of this ends up in being able to calculate funded ratio. So this slide is showing how the funded ratios have trended over the past several years. You can see the little kind of up and down where the those plans and systems with fiscal year end periods in the first half of the year have slightly better funded ratios. We'll see in a moment one of the reasons that might be the case. We also saw that in the first half of 2024, there was a significant uptick in funded ratios reaching over 83%. I do believe that is indicative of a trend because with the largest component of asset allocations being equities, equities have been performing very well and continue to in the second half of the year, and have so far remained stable to this point this year. So I would imagine that we'll see pretty healthy year-end funded ratios when the next iteration of this study is conducted. Now, we talked earlier about excuse me, drawing a blank on what it was. Oh, the type of amortization, those plans using closed amortization. Another best practice is receiving the full actuarially determined contribution. And this slide is showing that a very high percent of plans, at this point, it's now between 80 and 90% or higher of plans have received the full actuarially determined contribution in their most recent fiscal year, which is a really good thing. And on this next slide, you can see the impact that has on funded ratios. So the bottom line is for those systems that did not receive the full actuarial contribution in the most recent fiscal year, and the top line is those that did. And there's a pretty wide difference. On average, over this time period, it's about 20 percentage points difference. So this demonstrates, and it's likely that plans that make or receive the contribution in one year probably did the prior year and year before. Similarly with the amortization, and these things can help increase funded ratios as plans try to get to full funding over time. And I don't know if you have any additional comments on this before we hand it back over to Doug to start talking about some of the business practices.
Yeah, Eric, thank you. Yeah, I think this just underscores number of other studies by our sister organizations that have shown the same thing, that one of the key components of a stable and well-funded plan is getting the full ADAC. And I think this shows in very stark terms what the difference is between getting your full contribution from the plan sponsors and the consequences of not getting that full contribution.
All right, so I'll hand it back to Doug for this next bit.
Thanks, Eric. So there's quite a lot of operations, kind of what has happened in the past year, what has happened over the last several years, data in the report. I'd very much recommend perusing the report for more than just this chart and some of the others that I'll show. But I think this one was particularly interesting and worth highlighting in the webinar, in part because it's demonstrating quite a lot of action that's going on just in the past year is the purple bar, and what's being considered for 2025. So if you are kind of scanning through here, some of the most common business practices that were implemented in just the past year, conducting a death audit, enhancing member financial wellness, retirement readiness resources, updating or strengthening an asset allocation study, updating or enhancing administrative software used for member data. There's 47% who updated or enhanced an online portal provided for members to access account information. But you can also see there's plans to be doing this in the future too. So just because they implemented in the past year doesn't mean they weren't also kind of considering it for 2025. It seems clear that a lot of this is kind of ongoing work that these systems are doing and considering. There's also quite a lot of emphasis clearly on kind of enhancing member kind of specific resources or access points. We have the number 2 most common practice was enhancing member financial wellness and retirement readiness resources. I think that probably goes hand in hand with the updated or enhanced online portal. Fewer people have updated or enhanced a mobile app. That's the one at the bottom, but there's still kind of consideration among 2 and 10 for kind of working on improving that next year. The other thing that I wanted to mention, the 65% kind of looks like an outlier there, planning to update or enhance an online portal for members in 2025. In a separate question where we were asking kind of what is available, 77% said that they currently offer a digital platform. It's not surprisingly is more common among the largest systems that we surveyed. But clearly, with 65% looking to update or enhance, there's people adding to that mix, but also working to kind of improve what's available for members.
Yeah, and Doug, just as again, adding a little color, as many of the folks who are tuning in hopefully know, NCPERS, we host a number of different professional roundtables for public plan professionals. Among the roundtables includes the comms roundtable and member services. And not surprisingly, a member portal is a major topic of conversation among those two, or among those two roundtables.
Right. Moving forward, we actually wanted to kind of shake things up here at the end and ask a couple of poll questions. The first one about artificial intelligence. So this was a study that was very much focused on the present and trying to understand how systems are kind of investing and what assumptions that they're building into their plan, but also wanting to look towards the future, thinking about new technologies, new offerings, one of those being AI and what role is there. So I think we're going to ask a poll question of participants now, basically wanting to know, where do you think AI is in terms of public pensions utilization? So would you say that it's already here, it's being used in pension systems now, it's nearly here, it's being explored for use cases, maybe on the kind of near future horizon? Is it on the horizon, but not the immediate future, a long way off, or is this something that's not likely to ever be utilized in this space?
So we'll give you about another 5 seconds to take this poll and we'll put up the results. All right. Eager to see what people have said.
So it looks like we have some consensus that it's not here. It's also not a long way off, though. It's somewhere in the middle, which probably is the safe answer of nearly here, people exploring options in kind of an active sense, or, it's on the horizon, maybe not immediate, but interesting to me, we have 111 people voting here, only 8 saying that it's a long way off or unlikely to ever be utilized. So
Yeah,
yeah.
Doug, if you want to advance, but just a quick commentary. Obviously, NCPERS, we host a lot of educational conferences. I also attend a number of them as well, and AI is certainly somewhat of a topic du jour. But I think there is consensus that, while the promise seems very positive, um, the actual you know, application and in use by public plans is still more of a rarity than the rule.
So if we look at how the results of the survey shook out, I think it confirms kind of what we're polling in real time here, where not a lot are actually utilizing AI currently, but it's not nobody. There's over 1 in 10 systems saying that they're actually utilizing AI currently to help with participant communication and customer service. There's usage of it for automation of administrative tasks and processes. There's some kind of handful of people who are using it for other purposes. But I think what's interesting here, besides kind of putting a stake in the ground of something that will be interesting to track going forward, is there's a lot of consideration here. So we have 30% exploring the use of it for fraud detection, 23% for enhanced data modeling to identify investment opportunities. That represents, as we saw, kind of the breadth and types of systems that took the survey, kind of an interesting exploration of the use of AI across the board in the data. Larger systems, again, kind of a common theme of a difference between kind of the largest systems in the survey and the smaller. Larger are more likely to be utilizing or considering AI than are the smaller. I also think it's an interesting pattern of what is kind of the lowest hanging fruit, maybe, of improvements to participant communication, automation of administrative tasks, processes. I think that kind of matches how people are putting their kind of toe in the water across different industries of, there's easy wins of automating certain administrative tasks, and it can respond in real time in kind of sophisticated ways to customer service issues and things like that. One thing that I thought was interesting as kind of a comparison point, we had an open-end question asking people to describe what has been their most effective method for member education. And the number one choice there of kind of the most commonly mentioned method was newsletters, which feels like an understandable way of reaching lots of people. That's a long way off from kind of what AI represents, though. So I think it's an interesting exploration of how can you use this for customer service and communication, with how kind of the systems are currently communicating and finding ways to educate. It's also the case that engagement with anything related to retirement plans and any type of participants and members is tough. It's not necessarily the case that kind of a more interactive AI model is going to get people who aren't engaged to engage. So I think the AI represents an interesting opportunity for kind of exploring ways of making it more sophisticated, improving what that looks like, but doesn't necessarily solve for that bigger problem of kind of how do you get people to get onto the portal in the first place and kind of explore what is going on with their own retirement future. All right, last question, and the last kind of key finding that we wanted to talk about is the kind of most future looking, trying to understand what are the priorities for 2025. So we're going to see how people from the survey responded about what their biggest priorities are, but want to quickly poll the audience and see what you think systems are prioritizing this year. Just like before, we'll give you a few seconds. Doesn't need to be correct. Just what among these options feels like the priority should be, or where you think priorities land for people.
Give you another 5 seconds to complete the poll, and then we'll see the results. Great. If we can get the poll results, please.
All right, clear winner, sustaining target pension funding level. Makes a lot of sense. Number 2, improving cybersecurity and fraud prevention systems. Also makes a lot of sense. We'll talk about that in a minute. Looks like 3rd place, updating acquiring pension administration system. So let's see what the survey results say. Survey says we see the top 2 corresponding with what everybody here today is also thinking. The sustaining target pension funding level and cybersecurity are 1 and 2. However, I think the winner here is really interesting. Clearly, if you're looking at the percentages, you didn't have to just pick one. We were asking for what your 3 priorities were for 2025 in the survey. So you could pick more than one. You could be in multiple buckets here. But improving cybersecurity, edging out sustaining target pension funding level, I think speaks volumes to kind of how important cybersecurity has become, is kind of on the minds of retirement systems this year. You know, the sustaining the funding level is kind of the existential question here. But I think cybersecurity has also now become not only kind of existential, but kind of an ongoing priority. So I think the top 2 here make sense of how big a deal these are and how true it is. This would be top priorities for 2026 as well. We saw in the survey larger systems were more likely to say improving cybersecurity and updating and acquiring pension administration systems. Smaller systems were more likely to be prioritizing sustaining target pension funding level. We also had 64% say that they have cyber liability insurance. The one thing in kind of the lower priorities that I still think is important, determining AI's role in pension management, lower as a priority, but 25%, so a quarter of respondents identified that as one of their top priorities for 2025. So again, reiterating that this is on the horizon and not just a kind of a topic that the media is talking about or that we'll see in our apps and our phones and things like that. These systems are really considering AI and trying to assess it this year even.
Well, Doug, Eric, thank you so much for that great presentation. Again, we're so thrilled to have you as our research partner for the Public Retirement System study. This was our first year of the partnership. I'm already looking forward to the 2026 iteration. All right, so we are almost at the top of the hour. So let us switch gears, and I'll ask William to share his screen and demonstrate the online dashboard. William?
Great, thanks, Hank. I'm going to take a few minutes to demo the PRS study visualization dashboard that's now available for NCPERS members through our website. So we've created this dashboard to allow our members to interact
Hey,
with
William,
the database.
we are not actually seeing the dashboard. I think we're seeing a different screen there.
Sorry about that.
No worries.
Oh, okay. Can you see the dashboard now?
There it is.
Okay, great. Sorry about that. So thanks, Hank. Yeah, as I was saying, we created this dashboard to allow members to be able to look at the survey responses at a high level and generate custom comparisons that they can benchmark against, right? So they're getting those apples to apples comparisons that Hank mentioned earlier in the webinar. So when you first access the dashboard on the NCPERS website, you'll land here at this About PRS Study page. This landing page is your home base. This is your starting point. And this is where you can find background on the study, the methodology used, An overview of the database tabs here are listed at the bottom. All this information is sort of your starting point. You can navigate the the dashboard, the entire dashboard from these tabs up here at the top of the screen, right? So there are 8 different sections of the dashboard, and each one of these tabs is going to take you to a different section. They're available whenever you're here on the dashboard page. And so you start here, but then you can jump to different parts like, say, who responded, which you saw earlier in the webinar. We talked about this, cost of living adjustments, etc., broken down sort of logically into subsections of the survey that you can look at. So let's start with the who responded tab. This displays summary data about the responding plans, of course. You can see the responding plan type, the plan participants, fiscal year of the ACFR that was referenced, are they eligible for federal programs, etc. The interactive part of the dashboard is here on the left-hand side. So the left-hand menu is filters that you can use to filter down the data set into a small subset. And that allows you to compare yourself or maybe as your plan or against another subset of plans that you'd like to do a direct comparison to. So some of the options you have: number of plan staff here, the slider at the top, total number of participants. We've got those into under 10,000 plan participants, 10 to 100, over 100,000 plan participants. Total actuarial assets here, under $1 billion, $1 to $15 billion. These are all ways you can apply filters, slice up the data basically, and make a narrower data set, right? So these allow you to modify that and create that comparison group that you'd like to benchmark against. So to use a filter, just a quick demo, you're going to click the drop down. For instance, let's say you wanted to look at just public safety plans, right? So you have your public safety employees filter down here. You just click off the all, which is sort of the default state you start out in, and you say yes, apply. And you can see that the bars all change. And now we're looking at plans that responded 100% said that they were public safety participants related, right? Important to note, a lot of public safety plans cover more than just public safety, right? They might cover other types of government employees. So if you want to screen out those other types, you can go to, say, the local employees here and say, well, I don't want local. So I'm going to click no there and apply that. And then you'll see the chart in the upper right, the employee retirees served, locals went to 0, and we're just getting 100% public safety here. You can go through these other filters and customize it basically however you'd like to get your apples to apples comparison, right? The number of plan staff slider at the top also allows you to do something similar. It starts out by default 0 to 2,890, largest number of plan staff of any participating plans in the study. But you can slide that up. Let's say you want, 500 and up, something like that, but less than 1,000. Come down here, and you can see the bars change, the numbers change. Your data set is getting filtered down to who you care about. You can always go through and click the reset filter button that sits here at the top of each one to go back to the default state, right? Add back in those local employees, take off the public safety employees, right? So pretty useful and powerful interactive filters that are available to you. And these are available throughout the dashboard on each of these tabs that you go to. You can do similar things on the left-hand side, cut down to the custom comparison that you're looking for. So a couple of things to note. Good example is on this screen here. We've got a couple dot graphs where you can see anonymized information, but this is specifics on plan responding plans, just anonymous. You can see some of these charts have breakdowns by the number of plan participants categorized. So under 10,000 plan participants is this purple bar here. 10 to 100,000 is this green bar. And these are assumed rate of return assumptions, averages, right? So it's operating at a high level. Important to note, the dashboard is constructed off of the most recent survey responses, right? So as explained by Eric in the methodology section early on, we did a lot of detailed breakdown on fiscal year end dates. More detailed breakdowns and graphs are available in the report, which goes into real sort of deeper analysis of the ACFR data that was submitted by plans. On the dashboard, for simplicity of presentation and for ease of use, we're looking at response years, so 2024 responses to the survey. It doesn't get quite as granular as the report and as the charts that Eric showed earlier in the webinar that break things down by fiscal year. But it's a very powerful tool. We get great feedback. We hear very good things from our members about the past dashboards we've provided. Our compensation survey also has a dashboard that's similar, allows you to get down in the weeds and sort of do those comparisons and see how your fiscal and operational practices measure up. So we're very pleased to make this available to NCPERS members. It's available through the website. If you have any questions about the dashboard, how to use it, you can email research@ncpers.org. If you have any questions about NCPERS and membership and getting access to the dashboard by joining our organization, of course, you can contact me, William Whitman. I'm the membership director, as Hank outlined at the beginning. And yeah, I'll turn things back over to Hank. I know we've got a couple of questions we're going to try to get to in a Q&A here.
Great. Thanks, William. And when you get a chance, if you wouldn't mind putting your email address in the chat so that people can have it for the record. Okay, so we have a few minutes left. There are a few questions. Was there any information collected or will it be in future years regarding the low default risk obligation measure, LD-ROM, required by the actuarial standards of practice that was issued last year? So Doug and Eric, correct me. I don't think the survey instrument asked for LD-ROM numbers. So
No, it
I
did
think the
not.
short answer is no.
That's correct.
Excuse me. Great. Are the planned administrative expense ratios reported in basis points based on total fund assets, actuarial accrued liability, or some other basis?
I believe they're on fund assets.
Great. Thank you, Eric. The survey or the study noted that 15% of respondents are offering ID theft services insurance. Is there any sense of how much of that 15% is reactive in response to services being offered following a breach versus coverage available proactively? I think the answer is we don't know. We just asked that question, but Eric, do you care to expand?
That's correct. We didn't ask them if it's proactive or reactive. My sense, and this is from doing surveys for other organizations on fraud prevention and detection, that they're probably, if they're doing that, it's probably obviously if there's an event, they're going to do something about it. But they probably have tools that are being proactive and trying to watch for that. That would be my sense, but could be good chance for an audience poll or maybe in your question next year.
Yeah, great. Hey, William, to you, can you print results of the filtering on the dashboard or from the dashboard?
There's not a feature built in to print, but you can certainly do screenshots and then, of course, print those as images or share them. Yes, so it doesn't have any limitations in that regard, but it would just be sort of picture files as opposed to printing.
I think this is more of a comment. This is great data. eVestment NASDAQ focuses on pension performance data and manager data. So it's great to see the rest of the picture besides performance. Most pensions aren't keeping up with their actuarial rates. So important to see that is a top concern for them. 7% is still a tough bogey based on what I've studied. And then the question, will LD-ROM be collected in the future? I think it will be something that we will certainly talk about as we do a postmortem on the 2025 survey. It may be a great item to track, as we've noted. The thing that we have to constantly balance is detail of the survey versus the likelihood of survey respondents. So the longer the survey, the less likely the number of respondents, and the richer the number of respondent, or the more the number of respondents, the richer the data is. So it will certainly be something that we'll talk about. All right, folks, thank you so much for joining us. It's been a pleasure hosting this webinar. Again, great thanks to our Greenwald partners, Doug Kincaid and Eric Sondergeld, and William Whitman for that demonstration. Great. Thanks, everybody, and have a good week.
Thanks, everyone.
Bye-bye.